So I created these spreadsheets in order to, number one, educate, and number two, kind of just really peel back the layers and actually look at the numbers. So what I did was, compare the strategy buy term invest the rest versus directly investing into the S&P versus buy term or buy term and invest into the S&P versus IUO. So what is buy term invest the difference and invest the difference? So what you are doing is buying a term policy, and over the length of that term, you're supposed to be investing and growing your portfolio to the equivalent of the insurance of that term. So meaning you buy a $3 million term policy over 30 years, you're also investing the spread, whatever it is that you're investing year over year, and that's supposed to grow your portfolio to the equivalent of 3 million. And so by the time that term drops off, now you're quote unquote self-insured. That is what buy term invest the difference is. That's what a lot of Primerica agents say. That's what a lot of, gurus like Dave Ramsey says, any of those people who are against cash value life insurance or who are or just not open in general. Um, so that's what it is buying the term and then investing the rest. And more often than not, I'm just gonna be honest, I've seen this happen that they don't actually invest the rest. They never end up investing the rest. So and one of the biggest arguments that I see, and this is just one point of many, one of the biggest arguments that I see is that IULs are too expensive. The charges are too much. There's net amount at risk. Or excuse me, not net amount, there's annual renewable term. That's what Primerica says in order for you to push you away from an IUL. They use the ART, the annual renewable term. Little did they know, the net amount at risk is actually what's most important. That is what's most important. So I'm going to take one of their main funds. Primerica's main funds is the FKDNX. Okay, the FKDNX. So this is one of their growth funds. And then this is their fees. So 0.77 with their 12B1 fee. So that's actually going to be a total of 1.02. I didn't even account for this fee here just because I want to be generous and say, you know what? I'm not going to account for this. But they do have an initial front-loaded fee at 5.5%. And so what I did is I stripped the data. I went to Yahoo Finance, put in the ticker symbol, and went back all 30 years. Inputted all of this information into a spreadsheet. And so here, what I did, let me see, is this it? Yep. So over here, this is going to be the spreadsheet that I created. So what you're doing here for this individual is doing 10,000 a year. 10,000 a year, and then you're taking 2,700 a year or 225 a month, putting that into a $3 million term policy. So like I said, the goal is to accumulate your portfolio to 3 million. So then that way, when the term falls off, then you no longer need that term and you're self-insured, right? So usual term policies are anywhere between on 3 million coverage for a 35-year-old range anywhere between 150 all the way up to $300 a month, maybe more than that, depending on health rating or depending on all of these different factors that are involved. So again, when conservative, and I said, you know what? Why don't we do 225 per month? Okay, so 2,700 a year, and over the 30 years, the total cost is $81,000. So again, I backdated the information, stripped all of the data here, all the way from 1996. And so I took into consideration that fee, that 1.02 fee, and then the front-loaded charge, 5.5%. So that's their front-loaded charge that they have. So this is the total fee. And then their cumulative fee was about $196,000 over the life of the plan. And then there's something that we also have to consider too, is taxes. So I did a tax rate at 24% and a tax rate at 30%. Okay. So with that, at 24%, it's a total tax of about $667,000. And then in Cali, 834,000. So you're netting roughly, I mean, minus the fee, roughly 1.9 to 2.1 million. That's the rough estimate, net, right? And the average return is 4.6, 14.6. I mean, this is, again, this you had the tech bubble and tech burst. You had the AI burst right now. That's where we're currently in. You have all of the above. Like you had the longest bull run in US history. So you had all of that, and the average is about 14.6. Cumulative fee is about 196,000, and then the total opportunity cost is about $81,000. So that's just with the fund. This is pretty solid. I think overall, you paid $196,000 in fees over the life of the plan, along with the $81,000 cost. And now you're almost self-insured. I mean, you didn't get to that 3 million mark, but you sure did pretty well, right? So this is solid. And I'm not saying that this is bad, but again, for context here, is saying that buy term invest the difference into a mutual fund is superior to anything else. So now what I did was directly investing into the S&P. I took the VOO, the ETF VOO, and the ETF SPY. So I took that 12,700, which is the 10,000 invested, and the 2,700 in the term, and I combined that. So annually, it's 12,700, okay, every single year. Okay. So over the life of it, you have 1.79 million. So not as much on the growth side with this one. This one had 2.8 million. However, but look at your cumulative fee, 4,100, substantially more. Even on the SPY, 13,000, still a tenth, less than a tenth of what the cumulative fee was, right? The management fees and all of that with the other fund. Average was about 9.9, but this was passively investing. And then so your net after taxes and fees is 1.36 million for VOO. Net for SPY is going to be 1.361. And then I also took in consideration of taxes of 24% and Cali's at 30%. So 430 to $538,000 in taxes. So your net after tax value is 1.36. And then total 1.362, 1.255. Okay, now I did the same exact thing with that mutual fund. I did buy term, invest into the S&P, right? Same exact thing. So the $10,000 a year, 2,700 in that term. And then now that's 81,000 as a cumulative cost. And then look how little these fees are. Okay. So now without investing that $81,000 here, 1.4 million, you missed out on $300,000, 380,000. So that's the opportunity cost here. Okay. So you do protect your family with that $3 million policy. However, again, you miss out on some of that growth. And then now net of taxes and fees, you range from 987 all the way to 1 million. So net 987 to 1 million. Okay. So this is from a fee standpoint, this is probably going to be your cheapest, right? Even if you take out the term and just directly invest into the S&P, sometimes you might be better off. Okay. And then now I did the IUL, took this directly from the illustration. So directly from Allianz Life, their cap is at 12.25 with the S&P. Took it directly, took the charges directly, 35-year-old directly from there. And so now these are the charges. And then each year, this is the actual performance, 20.26, you capped out at 12.25. 31.01, capped out at 12.25. And so the years that you lost 38.49, you have zero, 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 right? So overall, the net is $1.4 million in tax-free accumulation. And then over here, you have a $1.6 million death benefit. So it comes down, I'm not comparing it's this or that, but when the conversation comes up saying, oh, those are highly expensive, they're highly commissionable, they're this, that, whatever. I mean, they don't know, they haven't seen a max efficient IUL, right? So that's the big argument. It's like, oh, they're super expensive, there's annual renewable term, yada yada yada, right? So this is 30 years. This is a 35-year-old all the way to a 65-year-old. And look at this. Cumulative charges, just about 42,000. So way less than the mutual fund, which is what together is $276,000, $277,000 compared to this 42. So substantially lower on that side. Uh, not not less than the S&P. However, with that, you do get a $1.6 million death benefit. That's also tax-free for your heirs. So again, and it comes down to leverageability. So this, you can borrow against it and still earn, right? These, you have to sell to withdraw, and you have to pay taxes on that. So that's the thing. That's the huge difference with the two. And again, IUL is going to do its job. You know, the mutual funds are going to do its job. S&P and 500, they all have different jobs. It's not about which one is better than the other, but when people become black and white and say that this is better than this, that's the issue. It's like, no, this is more expensive than this. Like if they take blatant statements, okay, let's run the numbers. Let's see the numbers. Let's actually look at the data. And so that's a big argument, you know, and sometimes people are pushed away from an IUO and people sometimes just ghost altogether because they hear another, you know, their friend say buy term invest the difference, who's from Primerica, right? I mean, it's just the facts. And so, like I said, it comes down to what job you want. Why don't you invest into all three, right? Why limit yourself to just one? I think that's a little bit closed off if you're not thinking about diversifying, right? I think it comes down to what you want this vehicle to do. Is this a tax-free supplement? Is this a volatility buffer? What role do you want this to play? But when you actually look at the numbers, it's actually very interesting. Yes, I'm not going to say put everything on the IUL. I'm not going to say that because you want to diversify. If you want to participate in the market, you can. If you want to participate in real estate, you can. If you want to invest into other areas, you can. But what I am saying is that this, when people make blanket statements on IULs and that it's basically demonized by people who are selling the exact opposite, to be honest, you know, like you have to take that with a grain of salt. Like whatever they say, whatever people say about buy term invest the difference, you have to take that with a grain of salt. And so more often than not, those agents from Primerica will more often than not say buy term and never invest the difference. Good thing you protected their family, but you never invested the difference. Each one has its role. Each one, it just comes down to preference. That's really what it comes down to. Is this the end all be all? No. Is the S&P the end all be all? No. Is that mutual fund FKDNX? Is that the end all be all? No, it comes down to layering your assets and building a portfolio that one mitigates loss. There's one thing I want to point out. So 2008, a 0% floor. Okay, you have $218,000 in cash value here. You lost nothing. Well, this is all net of charges taken out. S&P, person who invested the 12,700, 2008, they lost 90 grand, right? Over here, what do they lose? Almost about 70 grand here. In the mutual fund, they lost 41%. So that's almost 100 grand. And then look how long it took them back to get from that 221 back to, or excuse me, from that 130 back to that 221. Took him, I mean, 3 years to come back, right? Because they're also putting money in, right? And then now let's look at the S&P. 109 to get back to 178. Again, 3 years to come back. And then you see this right here, those three back-to-back years where we lost that. So we got to a peak of right before those losses of 70,000, and we dropped down to 62. And then we're at 81,000 here to get back to 81,000. It took a couple of years, right? So again, markets are volatile. The main thing is investing. The main thing is saving. The main thing is allocating. So again, now with this, it kind of gave them a head start, right? So after that loss, now 257, 301, 313, right? So that's the thing. It comes down to what best fits the individual. That's it, plain and simple. And if someone wants to just passively invest into the S&P, so be it, right? All power to them. If someone wants to invest into the mutual fund and buy a term, okay, well, let's review that term. Maybe you can get it cheaper if you're trying to reduce costs, right? So that's my thing on that. I know that, uh, like I said, it's not really black and white. It comes down to the vehicle, right? A Ferrari is not going to do what a truck does, right? A eco-friendly car is not going to do what a old school Mustang does, right? Vehicles have different purposes for different things, and different vehicles are going to get you to where you want to go. So, I mean, that's really what I wanted to cover with this, um, with buy term invest the difference, because I think what really drove me to this, I'll probably stop recording here. Um, Actually, no, I'll keep it. So what really drove me to do this and to actually look at the numbers is that I spoke to an individual, super gung-ho, super excited about, reallocating their investments and their assets and looking into other alternative strategies. And they had, a Roth that didn't really grow, that was very volatile in the market. And come to find out, they had a friend or spouse or whatever that was in Primerica, no longer in it, was in Primerica, and said, "Oh, IULs are horrible. They take all your money. They want to put all their money into it. They want to do this, that, and the third." It's like, okay, like of course, if it's a spouse, you're gonna hear them out. But again, like and there's that level of influence there. But you only can do what you can do. That's it, you know. Um, so that's kind of the reason why I wanted to run these numbers. That's really just the actual strip. the data. That's it.